Gold and silver cannot go bankrupt. Everything else can. That's not a slogan. It's the thesis one veteran precious metal strategist has built an entire career on, and after the year markets just had, it's getting harder and harder to argue with him. This is Kenji Sinclair. Today, we're breaking down 3 things most retail investors have never had explained to them properly. First, the real story behind the last time the US government confiscated gold, and the specific legal loophole one Wall Street-connected family used to make sure it never happened to them again. Second, why Poland's central bank has quietly bought more gold than almost any nation on Earth, and what its own governor said out loud about the reason. And third, the actual math behind the $10,000 gold target serious analysts are now pointing to, and why the recent pullback everyone panicked about was never the top. Start with a distinction almost nobody makes correctly. An investment is something you hope will perform. Wealth is something that survives. A stock is an investment. A bond is an investment. A pension is an investment. All 3 depend entirely on the systems around them continuing to function normally. Gold and silver don't need a company, a government, a bank, or a payment network to remain what they are. That's the entire argument in one sentence. If you own no physical gold or silver today, the honest answer to what risk you're carrying is simple. You risk ending up with 0 wealth whatsoever, even if your portfolio statement says otherwise. Everything else you might call an asset, your bank deposit, your bond, your brokerage balance, is actually somebody else's liability. It's a promise, and promises get broken exactly when you need them most. One veteran trader put it in the bluntest terms possible. Gold and silver are your only life rafts. Not investments, not a hedge, a life raft. The thing that's still floating after everything else has gone under. And there's an old line from Warren Buffett that fits perfectly here. Derivatives are financial weapons of mass destruction, and you only find out who was swimming naked once the tide goes out. When the tide does go out, when the system actually does reboot rather than just wobble, the people holding physical gold and silver are going to be among a very small slice of the population that still has real capital on the other side. Everyone else is going to be holding paper claims on a system that no longer honors them the way it used to. So here's a story almost nobody in finance media ever tells you, and it explains exactly why some families have been quietly protecting themselves from this for generations. Decades ago, a trader whose family had deep ties to Goldman Sachs sat down and worked through a very uncomfortable question. What happens if a government, facing a debt crisis it can't grow its way out of, decides it needs more gold on its own balance sheet than the public is willing to sell it? History already answered that question once, in the 1930s, when the United States government made private gold ownership illegal and forced citizens to hand it over at a fixed price. His solution was specific, and it still holds up today. He concluded that any gold minted directly by the U.S. Mint, modern American eagles, or coins minted before 1933, would be far harder for the government to confiscate a second time. Why? Because the mint itself sells those coins directly to investors. For the government to turn around and demand them back would trigger a legal mess, and pre-1933 coins are already legally classified as collectibles, not currency. Bars can be made illegal with a single signature. Foreign coins can be made illegal, but a government suing its own citizens to reclaim something it sold them directly is a much harder fight, and that family built their entire holding around exactly that loophole. Whether or not you think confiscation is likely, notice what that story actually reveals. The smartest capital in the room plans for the scenario nobody wants to talk about, and that same instinct, planning for the unlikely, unthinkable scenario, is exactly what's driving the biggest gold buyer in the world right now, and it isn't a hedge fund. Poland has bought more gold than almost any country on the planet over the last several years. When a journalist finally asked the head of the Polish central bank point-blank why, his answer was strikingly candid. He said that if someone ever pulls the plug on the global financial system, a system built almost entirely on electronic accounting records, Poland wants to be the country that isn't affected by it. And then he added the line that should stop you cold. Even though his bank doesn't expect that scenario, it's literally a central bank's job to prepare for the most unfavorable circumstances imaginable. Think about what that actually means. Gold doesn't care who wins a war. It's not a promise from a borrower who might default. It's not a treasury security that can be frozen, sanctioned, or politically weaponized the moment your country falls out of favor. And this is the part that gets missed. Central banks aren't buying gold to flip it for a quick profit next quarter. They're buying it because it carries zero counterparty risk, full stop, and that has made it the closest thing to a truly neutral reserve asset left on the planet. Now let's talk about the actual mechanics keeping this entire system running. Because once you see it, you can't unsee it. Over a century ago, a JP Morgan banker testified before Congress and said something that's aged better than almost anything else in financial history. Gold is money. Everything else is credit. In today's world, credit is treated as if it were money, and that substitution is the entire problem. Here's why. To grow the money supply, the system has to add more debt, and it has to keep adding more debt continuously because the interest owed on existing debt doesn't fully exist yet. It has to be created through new borrowing. That's not opinion, it's arithmetic. Stop issuing new debt, and the existing debt structure starts to fail because the cash flow to service it was never fully there in the first place. This is the inflate or die trap. If the system inflates the currency to keep servicing debt, your purchasing power erodes. If it stops inflating, the debt structure itself collapses. There is no comfortable third option. Look at the actual numbers. The US Treasury takes in roughly $6 trillion a year. About $1.5 trillion of that goes straight to interest payments alone, before a single dollar is spent on anything else. And the government is still running an annual deficit north of $2 trillion. Mathematically, that trajectory has an ending, and it isn't a gentle one. This is also why the people who actually run the system are more afraid of a credit contraction than almost anything else. A credit contraction just means less credit is available than before. Banks get nervous and stop lending. Businesses can't refinance maturing debt. Consumers lose access to new borrowing. That alone sounds manageable, until you watch what happens next. When financing dries up, buyers can't bid on assets, so asset prices fall. When asset prices fall, the collateral backing existing loans weakens. When collateral weakens, lenders pull back even further, and the whole cycle tightens again from a smaller base. It's less a single event than a chain of dominoes, and once the first few fall, the chain feeds itself. That's precisely why the system leans so heavily on constantly creating more credit rather than ever letting it shrink. Shrinking is the one outcome the entire structure is built to avoid at any cost. So here's where it gets genuinely interesting for anyone watching the price action. Gold recently pulled back hard from its all-time high, and plenty of people called it a bubble popping. Serious analysts disagree, and the explanation for the pullback is more specific than markets got scared. When a Middle East conflict disrupted a major oil shipping corridor earlier this year, global oil supply tightened fast, and oil, like most major commodities, is priced in dollars. Several nations suddenly needed dollars quickly to keep buying the energy they depend on, and one of the fastest ways to raise dollars is to sell some gold reserves. That selling triggered stop losses among momentum traders, which triggered more selling, which is exactly how a sharp short-term drawdown happens in a market whose long-term fundamentals never actually changed. And those fundamentals really haven't changed. Central banks remain net buyers. Mining output remains essentially flat, while demand keeps climbing. That imbalance alone is a recipe for higher prices over time, not lower ones. And here's the number driving current forecasts. Analysts are pointing to an intermediate target near $10,000 an ounce within the next year or so, with longer range projections reaching $8,000 to $10,000 an ounce by 2032. There's real historical precedent for a move like this. The United States was functionally bankrupt in 1896 before a JP Morgan organized gold loan helped stabilize the Treasury. 2 world wars later, capital flooded out of a devastated Europe and into the United States. And by 1945, America held roughly 70% of the entire world's official gold reserves. That's how the US became the financial capital of the world. Not through clever domestic policy, but through capital fleeing collapsing systems elsewhere. Europe today carries a similar structural weakness. Its debt is fragmented across dozens of individual sovereign borrowers, while the United States carries one unified federal debt. When confidence cracks, fragmented systems tend to crack first. For years, you can say a government's finances don't add up and absolutely nothing happens. Markets still function, currencies still trade, everyone still shows up for work. That's the trap. It genuinely doesn't matter, right up until the moment it matters completely. Gold and silver aren't a bet on chaos. They're simply the one form of wealth that doesn't need anyone else's promise to remain real. For a deeper technical breakdown of how smart money positions itself during major market rotations, watch our next video linked right here. I'm Kenji Sinclair. Stay sharp, stay positioned, and I'll see you in the next one.